Floating rate funds are investment vehicles designed to adapt to changing interest rates. These funds invest in loans made to corporations or governments, which have floating interest rates that are tied to a benchmark rate, such as the London Interbank Offered Rate LIBOR. The advantages of floating rate funds are that they protect investors against interest rate hikes and inflation and provide steady income. However, investors must understand the risks associated with these funds. The first risk of floating rate funds is credit risk. These funds invest in loans made to corporations or governments that may have a lower credit rating. As a result, these loans may be at risk of default, and investors may lose their investment. The second risk is liquidity risk. Floating rate funds invest primarily in illiquid loans that may be difficult to sell. When interest rates rise, investors may try to sell their shares to reduce their exposure to interest rate risk. If the market does not have enough buyers, these funds may be forced to sell their loans at a loss, which can reduce the fund's value. The third risk is interest rate risk. While floating rate funds are designed to protect against interest rate hikes, they may still be affected by market interest rate movement. If interest rates rise, the rate at which the loans made by these funds adjust to the benchmark rate may not be fast enough to keep up with the market. The fourth risk is prepayment risk. Loans made by floating rate funds may be repaid early, which can reduce the amount of interest payments received by investors. Prepayment risk can be amplified when interest rates are declining and borrowers may choose to refinance their debt. To mitigate these risks, investors should understand the credit quality of the loans held by the fund, the fund's liquidity, the sensitivity of these funds to interest rate movements, and the prepayment risk of the loans. In conclusion, understanding the risks associated with floating rate funds is important for investors. While these funds offer advantages such as protection against interest rate hikes and inflation, investors must be aware of the risks of credit, liquidity, interest rate, and prepayment risks.